We live? Or...
Yeah, we're live.
Hey, what's going on, guys? Daniel Diaz-Bravo here. Welcome to We Now Have a Name. Okay, for now. Maybe we'll change it later. Maybe we won't. But Breaking Barriers and Mortgage Lending. My name's Daniel Diaz.
And I am Mario Bravo with
That's
Acclaim
right.
Lending.
And our
Hey,
co-host. Huh?
I was going to say, are we introducing the name? Are we unveiling the name? Or are we holding that hostage?
Yeah, I know, right? Well, Breaking Barriers, bud. And then, so Mario, our co-host here. So what's going on, bro? This is our third episode. So
Third
what's
episode,
happening?
man. It's exciting, man. We got two in the books now. This is our third one. Super exciting. I'm hoping that, the people that are looking at these or watching these, right, that they're at least, going to get something out of it. I hope that they got something out of it on the first two. I know that we were a little bit more just introductions, right? Second one, we got into a little bit more in depth, but excited, man. It's a beautiful day. And yeah, here we go.
Yes, sir.
Episode number 3.
Yes, sir. So what do you have for us, man? What are
Yeah,
we going to be
man.
talking about today?
Yeah, so today is one of my favorite topics, man. It's gets me all excited when I can say, hey, let's start working on a pre-approval. So today we're going to be talking about the pre-approval process and what it looks like and what we are looking for when we're out there, you know, when we got the application in and we're looking to get somebody pre-approved. So let's start off, man. So why the pre-approval matters, obviously, right? So let's start off with that.
Damn, do you want to answer that, or do you want me to?
I mean, this is honestly when I say, hey, I got a full application, I'm working on a pre-approval. That's my happy time, man. That's my,
Yeah,
my time to
yeah,
shine. This is where I get to really pull some numbers, pull credit, right, and really tell them, hey, like this is what you're pre-approved for, right? So obviously, yeah, the pre-approval process, why it matters, right, is because you want to know what you could potentially qualify for. Okay, whether that's 100,000, 200,000, 300,000, right? Whatever that loan amount is, right? But it's so that you know what your buying power looks like and what you could potentially qualify for, right? I always tell everybody, hey, I'm going to pre-approve you for your max amount. And then from there, you can go out shopping. Whether you max it out or you don't, you find something else a little bit less expensive. But just know that you have the abilities to get up there. So,
yeah, yeah. No, that's good stuff. And the pre-approval is like, for me, what I use it as a tool to give that confidence, right? Like you're given that real estate agent confidence, but then the reassurance in the borrower, right? Number one, they were right. Like we talked about this in the last couple episodes of people being afraid, to buy and being told that they can't get approved. And so when we get the approval done and we start with the approval and we hand them that approval, that gives them reassurance and like excitement, right? Because they
yeah.
they thought they were going to get told no, you
Yeah.
know.
Yeah. And this is the time when we're like, hey, look, it's a yes, right? Well, partial yes, right? We obviously still have to go through the whole process, but it's exciting news. It's time to go shopping for a home once we say, hey, you're pre-approved.
Yeah. Well,
Let's I was
let's talk about that. Let's talk about that partial yes.
Yeah.
Because when you say partial, then it's like, well, is it really a pre-approval? So let's talk about that. What does that mean when you say, hey, partial yes? What does that mean?
Yeah. So to me, when I say, hey, like you're pre-approved, right? Obviously, we still have to go through underwriting. So I have already received your application. I've received your documents, right? Whether you're a W-2, you're 1099. And so I've already combed through everything, right? I've gone through your bank statements. I've checked your assets. I've checked your credit, right? Everything looks good, right? So we put it in our system, right? We have a system called Arrive. That's our point of sales. And so we've gone in there, we've structured the deal, we've come through everything, we've calculated your income, right? And I feel 100% confident that I can get this to the closing table. And so, that when I get that approved eligible, right, after running running AUS on there, I can then feel
What does AUS
confident.
stand for?
Automated underwriting system. So I feel confident that after that, right, I know that if I go and get these guys under contract over the weekend and they come back and they're like, here's my contract, then I can go then to the underwriter and say, hey, look, This is a stone cold deal. They've got good to great credit, whatever that looks like. They've got the sufficient assets. They make the right income to qualify for this home. Pending appraisal, pending surveys, pending homeowner inspections, pending homeowners insurance, right? We can get this done. We can help you, start building that generational wealth that we've talked about in the past and start making those memories.
Yeah.
To me, that's the partial yes, right? Because I feel confident. The only thing we need is just, hey, appraisal, order your survey, your inspections, the little things.
Yeah. A couple of things to that. Number one, we pre-underwrite the file, right? I mean, we're going in depth. We're looking at every pay stub. We're going through every bank statement. So what I always tell people, hey, I'm 90% confident that from the time that we completely pre-underwrite you and get your pre-approval out so you can go shopping, I'm 90% confident, okay? The other 10% are the uncontrollables, right? Now, I know, some people are like 90%, but here's the deal, right? In my job, in my part of it, as far as reading your bank statements, reviewing your pay stubs, checking your credit, right? You have qualifying credit, whatever that might be, those things. Like, as far as me originating the file and pre-underwriting the file, I am 90% confident. The other 10%, right, to make up the 100 to get to the closing table are things that we as lenders cannot control. So I'm glad we're talking about this, because there's the blessing and the curse of being a mortgage lender is that we have control in what we can control, but then there's a lot of things that we cannot control. As an example, the appraisal, right? The appraisal may come in super low. It may come in subject to repairs. There might be things that got to get completed for it to even meet FHA guidelines or conventional guidelines or whatever that might look like, right? So this is something we can't control, which is why we like to order appraisal within the first couple of days of getting under contract, so that they can go out there, and if there's something wrong, we have time to fix it and we're moving, right? So we'll talk more about that. But appraisal, something that we cannot control, and that's a big one. Inspections, right? Sometimes, I mean, there's some things that are wrong and they got to get done, but mainly the appraisal. Things that come up on title, man, you just had a big one, a file with, the builder didn't know and disclose an HOA and title found it at the very last minute. So just things where it's like, we as lenders do our due diligence and we go 100% on the things that we can control. So 100% on our part, but 100% to the table, we're only 90% once we complete your approval, right? So that's something to remember, because there's several approvals during the process, right? When we do your pre-approval, we have looked at your documents, right? We have taken it through the automated underwriting. We have an approval. And so we are confident, right? We are confident that we're going to land the plane and get you closed. So
I love that plane analogy, man. We've got to get that.
Well, maybe one of the episodes, we go through our pre-approval meeting. Yeah. The pre-approval meeting. Yeah. So we'll do a little role play. I know you love some role play.
This type of role play.
Yeah. Cool. All right. So,
okay. Besides that, so let's talk about, what is it that we're looking for when we're wanting to get somebody pre-approved? So I had already talked about, hey, if you're at W-2, what is it that we're needing, right? So for us, right, we're needing, obviously, your driver's license, a valid driver's license, whether, or an ID, better say.
Valid ID.
A valid ID, right? Because it could be a driver's license, it can be an ID, it could be a passport. I have one right now we're using her passport. She doesn't drive. She has her passport. Anything that is given to you by a government entity, all right? If we're W-2, then we're going to
unexpired, of course.
And unexpired, yes, of course. And so, if you're a W-2 employee, right, then we're going to need your W-2s for the last 2 years, okay? We're going to need 30 days worth of bank statements, most recent bank statements, okay? And obviously, we're going to need Did I say 30 days bank statements? I apologize. I said I need 60 days of bank statements, 30 days of pay stubs.
Yeah, we'll
30 days pay
rectify that.
stubs. Yeah. Yeah, we got to get that.
So 30 days most recent pay stubs.
Yeah, 30 days most recent pay stubs, 60 days worth of bank statements, your W-2s for the last 2 years, and a valid ID. That's what we're looking
for. Okay. So let's talk about, so we have, pay stubs, and we have the last 2 years of W-2s. What is it that we're really looking for in your employment history, number one, but your pay stubs?
Yeah, that there's a consistency on there, right? That you've been working, if you are considered a full-time, that you have been working your full 40 hours a week, right? If there's any overtime that's worked, awesome. If we have a history of that, we can definitely, utilize that. If there's extra things, right? Like bonuses. So those, as long as we have a 2-year history of receiving that income, that type of income, then more than likely we are going to be able to use it. There's some types, right? Like a lot of our oil field people that receive the per diems. Fortunately, per diem is not taxable. Majority of it is not taxable. And so we can't use that. Even though you might have been receiving it for over 2 years, some of that stuff we can't use. But that's the major stuff. Obviously, we want to make sure that, you're working your full 40 hours. If there's any overtime, we could potentially use it. Bonuses, stuff like that, right? If there's, obviously we look at everything. If you're an hourly employee, if you're a salaried, are you paying child support? Are you not paying child support? We look for all of that, to see. Do you have a 401k? Are you contributing to it? All that good stuff.
When it comes to the pay, what we look for is a 2-year history of income, right? A 2-year employment history. So we're looking for are there any gaps of employment? And then were there industry changes, right? If you tell me you work 40 hours a week, but the most recent 30 days of your pay stubs are only showing 30, or your year to date, right? So we call that variable income, hourly income. Some people might work 30 one week, 40 the next, and 35 the next, right? So it's just like not everybody's always working their full time. So we have to figure out, how to calculate that, how to take that income and make sense of it, right? So just because you make $30 an hour and you're a full-time employee does not mean that we can just take your 30 hours times 40 hours and make it work, right? Especially if you're hourly. Now, if you're salary, that's always the best, right? We get excited when you get a salary employee because it's pretty straightforward. You make a certain amount every single time, and that makes the approval process just a little bit easier. But when it comes to that variable, we then have to, put the picture together and put the pieces of the puzzle together and figure out how many hours, what are they averaging out? And so when you have that 2-year history of employment in the same industry or at the same job, we're able to get what's called a written verification of employment. It's a form that we fill out. We send it to your HR department, and they tell us pretty much what you've made on your regular hourly income, overtime if you've been working it for 2 years, that kind of thing. And then we take an average of those numbers. So there's a little bit of a process when it comes to calculating your income, right? Especially if, maybe you don't get paid vacation or paid days off, and you're averaging anywhere between 32 and 40 hours a week or whatever. So it's important that you don't just have, hey, Mario, I make this amount an hour, and Mario's like, here's your pre-approval letter, go on and get under contract without seeing the documents. And that's why we're having this episode, right? Because we do want to stress the importance of getting pre-approved.
Yeah.
And oftentimes it seems like a headache for the borrower to get us W-2s, to get us pay stubs, to get us bank statements, tax returns, those types of things, or to even reach out to their HR or whatever. But it'll be worth it in the end.
Yeah. Because we have a better reading of their history, their work history, and we have a much better idea of what, they could qualify for, more certain idea of what they could qualify for. So yeah, the importance of getting those documents into us is, it's high. It's super high. Now, what about a 1099, Dan? What do we need?
So
Self-employed.
1099, self-employed, right? Oh, independent contractors, self-employed income, however you want to put it. We need 2 years of your tax returns. And this is a very unique deal. We deal with a lot of self-employed. And nowadays we have, bank statement loans for self-employed. We have 1099 loans where they just kind of state the 1099 and, that kind of thing. So they're called non-QM, non-qualified mortgages. So there are different programs that we can do for that. However, if you want to get, which most people do, anywhere between 3% down and 5% down programs, right? You've got to be able to show income as a 1099 self-employed borrower on your tax returns, right? So we get this a lot in the trucker business, right? In the trucking industry. Truck drivers make boatloads,
Big money.
You know what I mean? So like they'll make 250K, 300K a year deposits, right? Show, right? They'll write everything off. So they're going to write off the gas and they're going to write off their tires and they're going to write off the maintenance and they're going to write off, anything you can possibly think of, they're going to write off. So at the end of the year, yeah, sure, you made 300 grand, 250 grand, 400 grand, whatever. Some of those guys make a lot of money. But at the end of the year, you're only showing $40,000 in income, right? That's been taxed, right? Because your CPA or your accountant told you to, hey, if you don't write this off, you're going to owe a lot of money. Okay. Which, by the way, I got a program for that. If you are struggling, you don't always have to write everything off. Okay. I have a program that'll help you if you're self-employed. So anyway, but you they show $40,000. Well, here's the thing. That's awesome. $40,000 divided by 12, whatever that is.
Handy dandy platinum or what?
Look at that. The handy dandy platinum, 3,330. Look at that. Huh? Look at that. Our dang. Anyway, so they're only making $3,333 a month, right? That's their income. Now, here's the thing. They have truck payments. So maybe they have 1 or 2 trucks. Maybe it's just one, but that truck payment's $1,000 a month, right? Well, that right there, you're already disqualified because I'm going to take this 333 monthly gross income, right? Net on the taxes, right? And I'm going to multiply that by, we'll just call it 49%, right? And we're calculating the debt to income right now. Yeah. Technically, we could only use $1,633 of that income to qualify you, estimated, right? Okay, so we could only use $1,633 of that income to qualify you for a home. So now we're going to take the $1,000 payment. So now we can only qualify you for
a mortgage payment of $633.
Yeah, $633. Okay, you're probably not going to make much, but here's what we get. I paid $250,000. What are you talking about? Yeah, no, I get it, bro. And honestly, that's awesome. Seriously, that's a lot of money. But you only showed 40, so if we can get you this, and that's where the problem comes up. So when it comes to self-employed, you really do have to think about, hey, am I going to be buying a house in the near future? Do I need to claim more on my taxes and show more income and pay taxes on that income so that I can qualify? Or the other option is we can go non-qualified, do a bank statement loan, a 1099 loan, a non-QM loan, and you'll have to bring anywhere between 15 and 30% down, plus your closing cost. So there are options, and I say 15% to 30% down payment because it all just depends on your credit, especially
program and the credit,
and the credit, because especially on those non-QM loans, right? But you're at a higher risk to them, according to the banks. You're at a higher risk, so they'll want more money down.
Yeah.
So just things to think about, you don't necessarily have to write everything off if you have a system in place. And that's the hardest thing. Like, you're either going to write everything off as a self-employed and put yourself in a position not to buy, because here's the thing on this is, right? So like, let's say this year, we're going to call this year 2022.
Okay. 2022.
That's what I showed. and I find out because I talked to a lender, man, okay, next year you're going to have to show more, right? So you say, all right, well, this year we made 400 and I'm just going to pay taxes on 150,000. So you're going like, okay, this 20 or 23, we'll call it 23. Yeah, 22. We'll call it 22. And then now in 23, you showed 150,000.
Yeah.
Which is awesome. Okay. But we're going to take 150,000. Okay. Plus the 40,000.
Still average that out.
Okay. And then we're going to divide that by 24 months. So now you're at 79.16 gross income. We can only use 49% of that. So now we can use 38.79 of that total income, right, for the house. But you still have $1,000, and this is just assuming you only have $1,000 truck payment, right? People have
you don't
credit
have any
cards. They have truck rate their own personal car payments. I mean, America's full of debt, and the number one killer of all deals is the car payment. The number one killer of all mortgage deals is the car payment, because the car payment
is.
Yeah, the car payment today isn't $250 like when I bought my freaking car when I was whatever years old. You know, the car payment today is $800, $750, $1,000, $1,200. They're big, you know. So we take $1,000. That's just for the car. So now we can afford $2,879, right? Assuming that he only has $1,000 truck payment and that's it. Like maybe we can do something with that in some parts of the world. In Colorado, it'd be tough.
It really would be. Texas, you probably could get something, but still be
It might not
tough.
be that nice, right? So all that to say, be cautious. Now, remember, we just averaged out 2 years. What is a scenario or a time where maybe we can use 1 year of your self-employed taxes?
That's a great question, man. And so we can normally use 1 year of taxes when we've been in the industry or in the same line of work for 5 years. We would have to get that. We would have to prove, right, through the Secretary of State that your company has been in existence for over 5 years, 5+ years. And I believe it's only Freddie Mac that allows us to go with a 1 year. Correct me if I'm wrong.
Freddie Mac will allow you to do 1 year if you've been in business for 5 years, right? So you got to prove it with the Secretary of State that you've been registered. That's the catch. You actually have to be registered for 5 years, right? And then you've got to show that you've done your taxes for 5 years, right? But mainly you got to be registered.
Yeah.
Because oftentimes, well, I've been doing this for 12 years. Well, the Secretary of State showed that you started your company, LLC or whatever, or you've been registered since 2023,
Yeah.
Well, I've been doing, so, though there's a lot of things.
Yeah. There's a catch to it, right? Obviously, the main one is that it's got to be registered with the Secretary of State in order for us to be able to use the 1 year of tax returns when you've been in existence for 5+ years.
Give me just a sec. I got to write this real quick. And then I'm going to go fill this water up. Stay tuned.
Stay tuned.
All right.
You sure we can? First episode, we're in the middle of it. We're just taking a kind of like a little breakdown. We're going to grab some water. Okay, sounds good? Yes. Okay, sounds great. That's good. That's good news. All right, sounds good, brother.
We'll have to cut that out. So, okay. So this is my number 4. All right, so where were we, bro?
So we were talking about how is it or what is the scenario in where we could use only 1 year of tax returns?
Yeah. So you just got to you've had to been in business or registered for 5 years, and only certain agencies will let you do that.
Yeah.
Which is Freddie,
Freddie Mac
to be able to use that. But, that could play out in your favor if you've been in registered company for 5 years, right? Because, the year in 23, if you showed 150,000, you could use that if you've been registered for 5 years and have been doing this for 5 years and have taxes for 5 years. So, the biggest takeaway here, in my opinion, is like, and it goes back to having that fear. Like, don't be afraid to have that conversation. When you're ready, right? When you're ready, talk to somebody. If you're 6 months, 7 months, 10 months, a year down the road, don't do it yet. Right? Because what's going to happen is it's a lot of information. And if you're not willing to submit documents, right, pull credit, right, to get the true financial story, you're never going to get an accurate answer. Like anybody can tell you anything just by having a conversation, but without having your documents and tax returns and pay stubs and bank statements and pulled credit to know what's really on your liabilities, you just cannot get a true confident answer. So just remember that, like when you're ready, if you're not ready for 12 months, don't like, in my opinion, unless you're ready, like to show stuff. That's my take on it. Maybe that's a little aggressive. I don't know, but like that's my take on it. Because again, anybody can tell you anything.
Yeah, and that's the biggest difference between being pre-qualified and being pre-approved. Where, with the pre-qualification, it's all hearsay. Hey, I make X amount of dollars. I've got this credit score. Okay, hey, you could potentially qualify for this. Versus where we have you pre-approved, obviously, we've already looked through your bank statements. We've looked through the W-2s. We've calculated that income. We've ordered the VOEs, added all the income possible so that we are confident that we can get this done.
Yeah. Now, to that point, we'll show the audience like ways that they can figure out how to pre-qualify themselves and get an idea, and, where to go to get an idea of their credit score. Because remember, your credit score, and I guess we could talk about this, in this episode, because it's all about the pre-approval. There's 4 different algorithms when it comes to credit, and so if you're pulling from like Credit Karma or something like that, you're looking at your FICO 8, right? Which is like, if you go take out a phone and make payments on it, there's a credit card algorithm, there's a mortgage algorithm, there's an auto algorithm, and then the FICO 8. And so oftentimes when you use Credit Karma or something, or you don't pay, most services you can pay for, and it'll show you your actual mortgage score. It's going to show you a much higher rate. So when we ask people, hey, when was the last time you checked your credit? Oh, I checked it on Credit Karma. Awesome. Well, what was it at? Right. It was at a 780. Well, I can almost guarantee it's probably like a 740, 730 on their credit. Or if they tell me,
we say that Credit Karma is plus or minus 50 points.
Most often than not, it's is minus on the lower side.
Yeah. Most often than not, it's on the minus side, right? But it's never accurate, or at least that we have noticed.
Yeah. So if you want to monitor, right? Like if you want to monitor your credit to know what your mortgage score is, you can go, the one I always recommend is My FICO app, and pay for it. And I think it's like $29.99 a month. And you can monitor it, and it'll actually show you your mortgage score so that you can at least have a good idea on what that looks like. If you don't want to pay for it, monitor it, right? Or pay $30, because here's the other thing too. We as lenders have to use our service provider when it comes to the credit reports. So, sometimes we get people that are like, hey, I just pulled my credit. I have it from this third party deal or whatever. Well, we can't technically use that, so we have to pull from our system, our service providers. Yeah. So,
and I'm glad that you brought that up, right? About like them having different credits, scores being pulled, or credit being pulled from their own providers, right? Because as a consumer, right, you've got to know that if they are shopping around, right, like we always tell them, like, hey, you do have the right to shop around, and you have what is that 30-day time frame or 30-day window where your credit's not, it's not deeply impacted.
Yeah, to go shop around.
Yeah.
So. And we want to know that. Listen, the only thing I would be looking for, and I say this because, it's kind of annoying when people shop around, right? And I know they want the best, they want the cheapest, but I can promise you, I'm the kind of guy that never pays for cheap. I've done it a lot in my life, and I've done it recently, and every time it's come back to bite. You know what I mean? And so, and I'm not saying like whatever, but what I'm going with that is like, hey, you can shop around. Sure. That's totally fine. Our thing is the experience,
Yeah.
on what you're going to get. from us, and then going back to explaining what the credit score is and which credit score to look at is, as a mortgage loan officer, that's our job, is to educate and consult our consumers, our borrowers, in what to expect, right? Because what'll happen is, I have I have a 700 score, and then you pull it, but you didn't preface with, hey, by the way, here's how mortgage scores work. There's actually a mortgage score. So the one you're probably seeing is way higher. If you don't preface that, if you don't explain that to a borrower, and then you go pull their credit, right? They tell you they're at a 695. You go pull their credit, and it ends up being a 615. Dude, they'll leave you so fast because they don't believe you. Because you didn't say anything about that. Oh, that doesn't even make sense. My Credit Karma says that I'm a 690, and then they're going to go to the next guy, and they're going to pull their credit, and it'll be the same thing. And so our goal is to always educate, always be consulting and helping borrowers understand why and what we're looking at and how that impacts them.
Great point. And that's what makes us different at Acclaim Lending, that we educate the buyer in what, the process looks like and what it takes to take them from A to Z.
Yeah. And we're overly, I think a lot of people have given me a hard time about being like, why would you tell them that? Like being overly communicative, and telling them too much. And to me, it's like, nah, man, like it just works. It works for us. It really it gives our borrowers an expectation and trust and confidence in us, right? Because that's just the truth. Like I'm a really direct dude, never going to sugarcoat anything. Right?
Why would we?
Yeah.
It's only gonna lead to potentially, worst case scenarios.
I always think of that NBC back in the day when we were kids. The more you know, right? Did you remember that?
No, I don't remember that one.
They would do I think it was NBC, but it'd be like a little. You want me to look it up?
Sure.
See if I could find this. I'm not gonna look it up, but it's like the more you know, right? They would do like some commercial about not doing drugs or something.
Okay.
And they'd be like,
we went from mortgages to
they'd be like, don't do drugs. And then at the very end, they'd shoot like a little shooting star. Says, the more you know. Well, like it's kind of goofy, but like for me is, hey, the more you know as a borrower, right? The better experience you're going to have.
Yeah. The more educated you're going to be at that too.
Yeah. Because like there's not going to be like these things that pop up out of nowhere. Right.
Like random HOAs when we were told that there was not going to be any.
That's crazy. I don't understand how the builder didn't know that, or the listing agent, but it is what it is, it happens. But yeah, but like stuff like that where they pop up and you're like, now that person feels lied to.
Yeah.
Yeah. So yeah, the more you know, right? The better. Right. And the other, go ahead.
No, I was going to just say, most definitely, the more you know, the better, right? Obviously, the more educated that you are, then the easier that the decision to make this purchase will be for you, right? You're not going to be second guessing yourself. You're not going to be saying, well, what if, right? We have a saying here, right? A confused buyer will never buy. And we don't want anybody to be confused, right? We want them to be knowledgeable. We want them to know where we're at, what we're doing, where we're heading towards, so that they know that we're on the right path.
Yep. A confused buyer never buys. So,
yeah.
Well, good.
Cool, man.
Do you have any more? Like, what else do you have? Because I think I have.
Go ahead. Well, then you bring it up. Let's see.
Oh, okay. So I was going to ask you, okay, so you have 100% of my documents. Okay.
Mm-hmm.
Like, I guess I'll talk to you in 2 weeks.
No.
Or what does that look like?
No. So with us at Acclaim Lending, we take immediate massive action.
IMA, baby.
And IMA, immediate massive action. So no, we don't wait for 2 weeks and then, hey, 2 weeks later, you're pre-approved. No. As soon as you get me the documents, I am going to start working on your pre-approval. I am going to work on calculating your income. I'm going to do a credit check on there. I am going to run through your bank statements, make sure everything looks good, right? We have the sufficient assets that we need to help us get to the closing table. And then I'm getting you pre-approved. My goal is to have read through all that in an hour, hour and a half, maybe 2 hours at most, make sure that everything is legit, everything looks good, and we have the correct income, and then push you forward, you know? Not because I'm greedy for money or anything like that, but I want you out there shopping, right? Because that's the exciting part for me. You're out there shopping, you're looking at homes. Hey, I like this on this home. I like that on that home. I like this cabinets, the color of the cabinets. I like the flooring over here, right? And you start building that idea of the perfect home for you.
Yeah.
And so, but obviously we'll run through the numbers. We'll make sure everything looks good. Then we'll set you up on a pre-approval meeting, whether that's face-to-face, whether that's in person, or we have to do it over Zoom. And so the goal of that, obviously, right, is to go over your numbers with you to make sure that you understand, hey, look, this is what I was pre-approved for. This is the max amount that I can qualify for, right? This is what the interest rates look like. This is what my monthly investment looks like. And this is what my cash to close looks like. And granted, everybody, at first, your numbers are going to be super estimated,
Highly estimated,
overestimated, right? Just because we don't have the actual property taxes on a home. We don't have a correct homeowner's insurance. We don't know if there's going to be an HOA, a homeowners association. So these are just to get you a good idea of what you could potentially be looking at. I always tell everybody when I meet with somebody, I tell them, hey, don't panic. Have a glass of water. Don't freak out on me. These are just numbers to show you what it could potentially look like in this scenario, right? Once we start shopping, then we can narrow these numbers down a little bit more and give you a better number at what you could be at, more accurate number of what you could be looking at.
And the way that we've set up our system, well, let's go back to the pre-approval time frame. 1.5 to 2 hours, right? Once you have 100% of the documents. If you find out while looking at their pay stub, there's an instability of income as far as variable income, right? Like 1 week they work 25 hours, the other week is 40, the other week is 35. Like you're going to have to get a written verification of employment from the payroll.
Employer themselves.
From the employer themselves, HR, payroll, whoever's in charge of that. So that kind of thing will slow you down a little bit, in the approval. It depends on the borrower's company. Sometimes it takes 24 hours. Sometimes it's like within a couple hours if it's still early on in the day and they can get to it. Other times we have to go through third-party organizations to find that information, and it just takes a little bit. But for the most part, if we don't need to get a verification of like upfront to really calculate your variable income, we can push an approval out within 2 hours. I give myself 2 to 4 hours, so I can go through it thoroughly and, make sure. So just keep that in mind. One other point. So 2 to 4 hours, the pre-approval meeting, which we should probably do an episode on just that alone, having that pre-approval.
I think so. Yeah, we should do one on the pre-approval meeting just on its own, because definitely would love to run over a scenario and maybe bring up our blue sheet on there. That'd be nice.
Yeah. The pre-approval meeting is the most important part, in my opinion. This is like, hey, this is us. Once we have the meeting, that's when we give you the pre-approval letter. So you are then free to go about some shopping, but it's the time to answer all questions. Like we're going to go over numbers, they're overestimated. So if you do get an approval from us, our numbers are overestimated on purpose. We've set it up that way on purpose to show a higher number than what it will be at closing. There has been very minimal times where the numbers have been more than what we've overestimated. In fact, I don't even remember, to be honest with you. And that's like I don't remember. But I am confident that these numbers will be lower at closing. And I am confident because while we're going through underwriting, the numbers are getting balanced out. And so that's why you get multiple approvals and numbers are getting balanced out. Things are going down, right? Things are getting more accurate, et cetera, et cetera. So we've done in my personal opinion, we've done a really good job at creating a system where we are overestimated and we preach that and we tell that to our borrowers, right? Because if they take our estimate our blue sheet, right? And they go to freaking, Willie
Crazy.
Nelson, you know what I mean? Like down the street, and they show them to that person's going to be like, oh yeah, like check this out. Like I'm going to crush this. Right. Well, of course you are, because Acclaim Lending overestimated on almost everything,
Yeah.
on purpose. Because at the
Yeah.
end, we want our customer to feel better about those numbers, right, than what they saw originally.
Yeah.
Right. We could easily, right, hands down, we can go to a title company and get a fee sheet, and we can maybe even get like an estimate from an insurance broker and all this stuff, right? And like get the numbers real tight. Like, hey, this is tight. But then the reality is it doesn't give us much room for error. And here's the thing, and this is the vulnerable part, is last time I checked, we are human.
Yeah, we are. Yeah, we are.
So we make mistakes. Maybe we miscalculated the insurance. Maybe we miscalculated by $1 in the income, or $20. $20 makes a big difference in an approval, believe it or not, in today's market.
It really does.
And so when we do that and we overestimate the numbers to give you your all-in investment, and we give ourselves room for error, right? A margin of error, because we are human.
Yeah.
As much as I know we're good at what we do, we will make mistakes.
Yeah.
So
at the end of the day, we are human. It's nature. It's nature to make mistakes.
and it's hard to admit for me, like I'm really hard on myself when it comes to making mistakes, and I'm extremely hard on you guys, but I'm just as hard as I'm probably harder on myself than I am on you guys, hands down.
Yeah.
So we don't want to but we do give ourselves, and it's designed that way. It's by design. So
yeah, at the end of the day, right, if those numbers, when those numbers come down, not if, when those numbers come down, right, it's just going to make the borrower feel a lot better, right? Because, hey, Mario said, I was looking at $20,000. Well, it came down to 17. Well, guess what? I got an extra $3,000 because I saved up for $20,000 that Mario said. And now I have to pay the movers to move my stuff over to the new home.
Or buy a couch.
Or buy a couch, or a refrigerator,
right?
Whatever. Whatever it is. Washing and dryers nowadays aren't cheap, man. So
yeah. So good.
So now, one thing we skipped, or I'm not skipping, right? But after they're pre-approved, how long is that pre-approval good for?
Well, I usually tell them 60 days. I think technically it's good until they're, I think technically good until their credit report's no good.
Which is 90 days.
Yeah.
Yeah. So it's 90 days. So you technically have 90 days, right? Obviously, to shop around before we have to do a whole re-credit pool, do all that jazz again, but the goal is obviously to set you up, if you're not already partnered with a realtor partner, set you up with somebody great that's going to help you find your home.
Yeah. Well, and here's the other thing to that, it is 90 days, right? That's when the credit report, but like there's so many things that could happen between day 1 and day 60, right? You get sick, so you haven't been working, but you don't have paid time off or sick leave or whatever, so like we're always in communication with you. So after you're pre-approved, you're going to hear from us weekly. Kind of annoying. Okay. But you're pre-approved. You want to buy a house. We want to know where you're at. We want to keep your file up to date. And we want to get you, we want to get you inside your home.
Yeah.
Because at the end of the day, you reached out as the borrower, you reached out to buy a house, to buy a home.
Yeah, and we want to keep you informed, right? What if you're browsing on Facebook and you see a home and it's in your price budget? You haven't gone and seen it, right? It's on the list for the weekend, but you already want to see something that's, what the monthly investment would be on that one. We're in contact with you. Hey, have you seen anything out there? What do you need from me? Just to always make sure that they are educated.
Yeah.
And
to that point, like there was a time where we thought about doing some digital programs that could calculate, like if they're out, they just plug in the thing based on their approval, and then I started thinking about that, and I was like, man, that really takes away from the interaction, the relationship, the connection, right?
Yeah.
And
Yeah.
and solidifying the relationship. That takes away from that. So they're great programs and they're sweet, and I can see how they work because you don't have to necessarily be around on a weekend. They just plug it in. They know what their max DTI is. They know what their max approval is. You put the rate in there, that kind of thing, and you can update it daily or whatever. And then they just kind of push out their own pre-approval and they'll know. But, we built this business off of, hey, I am available. I'm available. I'm available on a Sunday night when you're feeling anxious about buying and closing on Tuesday. I'm available on a Saturday night when, you got to get documents and you're upset because we've been asking for the same document, which, by the way, we tell people that. But like, we're available. And so I started thinking about that. I'm like, you know what, man, I'm kind of glad we didn't do that, because then it would take away from us being like, hey, thanks for calling. Man, I didn't know you were going out today. Thanks for calling. Like, let me get some numbers put together for you. And you send them over our blue sheet, right? Hey, I just sent over a new blue sheet with some updated numbers on the house you're going to go look at. While I got you on the phone, hey, pop that open real quick. Let me know what you think. You got any concerns? On a scale of 1 to 10, how do you feel about this payment? Scale of 1 to 10, whatever. And that really gives us an opportunity to talk to them again. So as great as those digital formats are of the pre-approval, the free pre-approval things that go out, the generators, I just think it's a great extra mile thing to stay in contact.
Yeah.
It gives you a reason.
I agree. Staying in contact, I would much rather have them call me on a Saturday afternoon, Saturday evening. Hey, I'm looking at this home. I want to see what numbers look like, and I know where we're at, than them just plugging in some numbers to a random generator on their phone and not knowing if they're really getting an accurate number or what they're looking at, right? And now they could possibly get discouraged.
Yep.
So,
Yep.
I mean, that's why we do our due diligence. We go through the county websites, we get the property taxes, we do everything to get them as close as possible to what they're actually going to be looking at. So,
Yep. Let us work for you. I always like to say, hey, look at us as attorney and client. We're your attorney. We're representing you. We're going to fight to the death. We're going to fight to the end for you. And the judge is the underwriter, right? They're looking at your file. They're looking at your income. They don't necessarily, without making an underwriter sound bad, right? They don't necessarily want to give you the house. They're looking for stuff.
yeah.
Right. That's why they underwrite it, just because they're fine tooth comb.
Yeah. Fine.
Right. They're looking for the shit that's, hey, this doesn't look right. This looks like fraud. This does, right. And so we, help us help you as the borrower, right? We're your lawyers. So give us everything, give us the entire picture so that we can then go represent you the best and fight for you when it comes to the underwriter.
Yeah.
That'll be a good episode to write that down, because that'll be a good one. But that's all we have. In the next episode, we're going to talk about what having a really good having a really good realtor partner on your side who has a relationship with the lender. For us, it's a referral partner, but for the borrower, it's their realtor, and having a really good realtor on your side that works with the lender regularly and understands and aligns with their systems and processes. And then we align with their systems and processes. So join us on the next Breaking Barriers in Mortgage Lending to meet one of Mario's referral partners and friends. And,
Yeah, I'm excited to bring this guy on, man. He's a young guy, been 4 years in the industry, and he's killing it. So I'm excited for him to share his point of view and talk to us a little bit more about what he expects from us and what we expect from him, because it's going to be a really, really great episode. And so, Dan, before we leave, where can they find you?
Yeah, so you can find me on Facebook and Instagram. TikTok's going away. Either way, my handles are the same. Facebook and Instagram at Bravo Loans. Our website is www.acclaimedloans.com. You can find me there as well. But at Bravo Loans. What about you, Mario? Where can they find you?
Well, they can find me on Facebook. It's Mario Bravo hyphen loan officer. And on Instagram, it's Bravo Mortgage Experts. So look me up, give me a follow, and let's connect. Any questions that you might have for us, whether Danny or myself, give us a call. Shoot us a message.
And if you've taken anything away from this episode, you know, a big takeaway, a light bulb moment, you know, it's changed the way you look at things, it taught you some whatever, right? Do us a favor, like our channel, subscribe to our channel, and hit that like button and share it. Share it with a friend, a family member, a coworker, your dog. I don't care. Just share it. Yeah, but really share it. We would greatly appreciate it, and that's gonna be fun. So tune in next time. We'll talk to you guys soon.
Sounds good.